Hi, my name is Mike and this is Real Estate in 10 and this is the Halloween special, brother. Anyways. Looks like we're all becoming renters now. There's a drastic increase in foreclosures by 67%, and just in time for fall, the feds are giving us more of what we love, some of that pumpkin spice inflation. According to Rent Cafe, over the past decade, dozens of suburbs have transitioned from a majority of homeowners to a majority of renters. And this is a kind of a trend that's going to be projected to grow over the next few years. Rent Cafe looked at the data over 1,000 suburbs in the nation's 50 of the largest cities, and they found that in 242 of the suburbs, renters outnumbered homeowners. Which makes sense. Millennials were all about experiences and less ownership. And then you also have home prices skyrocketing or continuously skyrocketing over the prior years. People were a little gun shy from the '08 recession. And then looking at the big picture though, I don't necessarily like this trend, but I understand why. Anyways, moving on. Foreclosures are on the rise, increasing by 32% from Q3 to Q4, and up by 67% from last year. But again, we're dealing with extremely low numbers here because of the federal intervention keeping national numbers low. So in other words, going from virtually 0 to 1 is an enormous jump, or seems like an enormous jump. But really, we have to remember when it comes to real estate, there's no one market. There are many markets. So sure, Oakland County is showing signs of strength, but parts of Wayne County is still questionable in my book. But overall, looking at the big picture, we're still 40% lower than the pre-pandemic numbers, and we also have to mention that the real estate market isn't like the stock market, where you can day trade, whereas real estate works at a glacier's pace. Thus, if something happens today in the stock market, or if something happens today, the stock market feels it right then and there. Whereas if something were to happen today, the real estate market won't necessarily show signs of being affected months down the road. In other news, the September jobs report came out and it was lower than expected. More and more people left their jobs either from retiring, you also have employment scarring, and potential employees have time to compare where they want to work. They don't necessarily have to rush into the next job, which is awesome at the individual level, but for a made-to-order market or just-in-time shipping, that will affect the average consumer prices and wait times. Then you have prices of exports and still rising, and import prices up by 9.2% year over year, which in the long term means that we're going to continue to have some of that inflation in the near future. Mix that in with a 5 million home shortage nationwide, and I think we're still going to be battling with low amounts of inventory leading into the next year, and maybe then some. So will they essentially begin to taper in November like they were saying before, or last month? After the subpar jobs report, I think we're probably back to saying it's a strong maybe and not a definite thing anymore. But again, it's not all bleak. Transactions are being made, residential is still slightly cooling off, sure, which is a good for buyers, but at the commercial level, you see signs of continuous improvements. There was a Cranes report the other day about the Detroit hotel, the Westin Book Cadillac Hotel, which had a distressed loan, which was actually essentially picked up by Oxford Capital, which they plan on improving and maintaining the property overall in the near future, in the next few years. You have also Google buying a $2 million property in New York, Blackstone making a huge return on investment from selling their Cosmo in Vegas. For sure, they are corporate behemoths making transactions, but it goes to show that private money is still being passed around. Unlike the '08 recession, and granted, the example is a little loose here because of the sheer size of these companies, but again, what I'm trying to convey here is the difference between then and now, right? So supply was very high in our last '08 recession, or last Great Recession, and because it kind of stretched from like '08 moving forward, and you couldn't essentially get the funding, right? There was tons of supply, but there was not enough funding, not a lot of backing, or at least for the mass majority of Americans. But that's why the feds bailed out the banks. Whereas today, there is a very low supply in almost every market, but everyone is flushed with cash, generally speaking. Anyways, that's the news for this week. If you have any questions, reach out to me and I'll be more than happy to answer. Have a great rest of your day and happy Halloween!